What if your next property tax bill could be hundreds, or even thousands, of dollars lower? 11 property tax exemptions and breaks you should know about. If you're a homeowner, you might have noticed your mortgage creeping up. The likely culprit? Property taxes. Here's a breakdown of 11 property tax exemptions and credits that could save you money. Homestead tax exemption. This exemption allows you to deduct a portion of your home's value from property taxes, which lowers your annual tax bill. Many states offer enhanced benefits for seniors, people with disabilities, or military veterans. You'll usually need to live in the home as your primary residence and apply through your local tax assessor. Veterans property tax exemption. If you're a military veteran, you may be eligible for a state-specific tax exemption that reduces the assessed value of your home. These benefits often vary depending on your disability rating, service history, and income. In some cases, surviving spouses also qualify. Personal exemptions. Some local governments offer personal exemptions based on factors like age, income, or disability status. These are tied to the homeowner, not the property itself, and typically reduce the home's assessed value, which means a lower tax bill. Head of family exemption. In certain states, if you support dependents and live in the home as your primary residence, you may qualify for a head of family exemption. This can lower the taxable value of your home and reduce your annual tax liability. Property tax relief programs. These programs target homeowners facing financial difficulty, often seniors, veterans, low-income households, or those affected by natural disasters. Availability and requirements vary by location. Veterans with service-connected disabilities may receive a full or partial exemption on their primary residence. In some states, the benefit can extend to a surviving spouse. Check your local rules to see how this applies in your area. While not a direct property tax break, the mortgage interest deduction can reduce your federal taxable income. Most homeowners can deduct interest on up to $750,000 of qualified mortgage debt, or $375,000 if married filing separately, as long as the loan was used to buy or significantly improve a primary or second home. Mortgage interest credit. If you received a mortgage credit certificate when you bought your home, you might be eligible. This can offset up to 50% of your annual interest, though the credit is typically capped at $2,000 per year. It's especially useful for lower-income buyers. Installing energy-efficient upgrades, like heat pumps or energy-efficient windows and doors, could get you a federal tax credit. These are typically capped at specific amounts. For example, credits may go up to $2,000 per year. Installing an EV charging station at your home might qualify for a federal tax credit worth 30% of the installation cost, up to $1,000. That's in addition to any EV purchase incentives you might receive. If you've had to make home modifications for medical reasons, like adding a ramp or modifying your bathroom, those costs could be deductible. You can generally deduct the portion of medical expenses that exceeds 7.5% of your adjusted gross income. Property tax exemptions and credits can offer real savings, but they often require proactive applications and vary by location. Check with your city or county tax office to see what's available in your area. The right exemption could make a meaningful difference in your monthly costs.